thank you, Art, for the knowledge and the legal tips for startup funding with corporate VC investors. Is there anything else you want to share before we kick off the Q&A session?
No, I think I'd love to hear what questions there is out in the audience.
Thanks, Art. You mentioned IP. Does startups has any bargaining power or only follow the corporate rules?
That's a good question and a very real and practical question. You know, I do think you have more power than you think because if you're talking about corporate venture capital or these collaboration programs, these accelerator programs, any venture capital fund, whether it's corporate venture capital or institutional venture capital, is going to not always railroad the startup with onerous terms, whether it's on IP or control or even on valuation. Even though the bargaining power can be quite a big difference, funds and including corporate venture capital is very aware of its image in the market. So funds can develop and corporates can develop a reputation for being hard to work with. And people here know, I'm sure, that the founder community, the startup community is a very small community that talks to each other. So I think the straight answer to that question is you have probably more bargaining power than you think. What's presented to you as our standard terms and conditions is not always non-negotiable, because I think if something's really truly onerous, the corporate or the venture capital fund will not necessarily want to really have that in there anyway, because they're conscious of their reputation as well. I just don't want to lose it because we had a great question, if you don't mind. We had a great question come in earlier, and I wanted to hit that question just because I thought it was a fantastic question. It was about someone who had a startup, I think, and they're not really a startup anymore. They have a 15-year operating history, I think, but then they're debating whether they should reach out and get funding or not. So that was a real case. I thought I would tackle that one. I mean, know, I think that's a good question in the sense of, if your company is already healthy, profitable, self-funded, you don't need more funding to keep doing what you're doing. And maybe you need more funding to grow faster, but you don't necessarily need funding to keep on your current track, which is healthy and profitable. I do think you want to be always a little cautious about taking funding for the sake of taking funding. Now, having funding is good in the sense that you can get relationships that way, you can get network, you can get access maybe to more customers that way. And that's really what you should be looking for if you're in the great position to be to not need funding, but maybe benefit from funding as an extra bonus if it helps you in some other goal for your company. So, because on the other hand, you do need to be aware that, of course, when you raise outside capital, you are diluting obviously the ownership that you have. You have to give up ownership. Maybe more importantly, you have to give up some control. Now, if you're dealing with, let's say, your first outside investor and it's a professional investor, they're probably not going to ask for at most 20%, right? And probably less than that equity. In doing that, even though they are not a majority shareholder, it still brings in complications on the ownership structure. And for example, are they investing in local RMB? Are they investing in US dollars? It depends a little bit how your structure is set up. But all of that affects both how your company operates and then may add some extra pressure and reduce your options on exit. So again, going back to what I said before, once you have an outside investor, you have to be aligned with them on when they get their money out and what are they trying to get out of the investment. if it's an institutional venture capital fund, they're in it purely for the return, which means they're going to put pressure on you to come up with a business plan and a timeline that lets them get their money out. And it's rare for a venture capital fund position to be bought by another venture capital fund or another buyer. That's usually a somewhat illiquid position, which means that if you have outside capital like that in the company, you're really looking at either someone buying you, an acquisition, so that then everyone can cash out, or an IPO. And a lot of businesses are just not the type to go IPO, whether it's the industry or for whatever reason, the market that they're in. So just be aware that if today you're taking outside capital because you want to grow, be conscious of how is that aligned with your long-term strategy as far as the help that you can get from that investment and your timeline for the founders exiting the company. And if you need to be on the same page as your investors, whether they're corporate venture capital or institutional venture capital. So that's the things I would be worried about if you're in the good position to not need to, but benefit maybe from raising outside funding. So that was a great question. I just wanted to tackle that one because it was a very specific question.
Okay, I see tons of more questions loaded in. So it's glad to have Elizabeth here, and she has two questions. First, about what are Chinese investors cautious about when working with foreign startups? And the second question, I think we have already answered, is what difference between institutional VC and corporate VC when it comes to expectations for the startups?
Right. So let me tackle that. Chinese investors working with foreign startups. So that is still, I don't want to say it's rare, but it's truly local funds, especially ones that are investing in RMB. By the fact that they're investing in RMB, really you need a local structure. And so what that means in practice is your business is going to be set up after you take their investment as a 中外合资, right? It's a Sino-foreign joint venture. The only complication that brings is, again, the exit. If your capital is at RMB, then you may be limiting yourself, unless you do some kind of a large corporate restructuring later on. You're going to be limiting your exits to China, whether it's China capital markets on an IPO or an M&A buyer. And so that's for the startups perspective. From the Chinese investors perspective, why are they cautious? I think there's always going to be some cultural issues there, and that's just whether it's big companies, small companies, startups. I've been here 13 years, and those issues just are always going to be there. And I think Chinese investors, when they're investing locally, are want to be very helpful in developing the local market and using their relationships to do that. But then sometimes that may take the focus and put it completely on China, sometimes to the exclusion of markets outside of China if you're also looking to be a global company at some point. So that's one thing where I think both from the startup's perspective and the investor's perspective, sometimes it can work very well, especially if you're clear that your market is primarily China and always going to be China. I think it can work. But if you're planning to be a global company down the road, you may need to think about that when you're taking Chinese investment.
Okay, so right now, Emily has a question about how long does it take for the negotiations, by the way, starting the conversation with corporate VC and finally get the money?
Right. So this is always a frustration of startups, and having worked with a lot of startups to do these kinds of fundraisings, it can never be fast enough, right? And so, um, if we're talking about angel investment, for example, let's go way back to that. That should be the fastest, but often even that process is very drawn out as you're lining up multiple investors and get everybody on the same page. When you get to the institutional venture capital stage, a proper what we call the Series A round, um, those funds tend to move faster, particularly obviously if your startup is doing well, if it's competitive, multiple funds are interested in you, then the process can move very quickly. The whole transaction can be from term sheet to closing can be closed in a month, right? Now, if you're talking about corporate venture capital, again, it depends. Is the corporate venture capital leading the round, or are they co-investing with an institutional venture capital fund? If they're co-investing, the institutional venture capital fund may be able to pull them along faster, and they're just kind of following along on the due diligence and then investing with them along with the relatively same terms. That tends to speed things up. If the corporate venture capital fund is driving the process itself, especially if it's not one that has a big local team here in China, there's going to be a lot of coordination back with headquarters. This could be a multi-month process. And so what's difficult about that is the dynamics of the business may change in the interim, right? The company may be doing much better, but you're still dealing off a term sheet from a few months ago. And so that's where it gets really tricky in these long drawn out processes.
Okay, nice. We have a very good question from featuring arts. You talked about valuations, risk management between CVCs and IVC. How do they differ in terms of control terms they demand, board seats, veto, etc.?
Yeah. Good question. Very good question, because that's a very practical question, and especially from the startup's perspective, sometimes it's good to have very knowledgeable people on your board. Sometimes you don't want too many cooks in the kitchen, right? You don't want too many people, outsiders on the board, because it can sometimes slow things down, and people offering different opinions, and it just slows the whole process down. Generally speaking, so institutional venture capital funds, if they're investing enough, let's say, maybe 10% equity in the company, they're going to want a board seat, and they're going to deserve a board seat. And that board seat is, on the one hand, yes, to keep up and keep active in the discussions on the strategy and the direction of the company, but also it is in itself a control mechanism whereby their director has the veto rights, which the question alludes to, has the veto rights to stop the company from doing things, maybe issuing more shares that might dilute the VC's holdings, doing a down round, changing the business scope of the company, or taking out debt. There's a whole list which we see over and over again in these deals. And so as a control mechanism, institutional venture capital, again, above a certain threshold of investment, is definitely going to want to have a board seat. For corporate venture capital, it's not as crucial, because again, they're not necessarily looking to have as many of these rigid control and veto rights in place. They are looking for access and opportunities to work with the startups, but they don't necessarily need a board seat to do that.
Okay. Thank you for answering these questions. It seems like people are very interested with this topic. And people were asking, do you feel Chinese corporate investors are similar to multinational investors? It's quite new in China.
Yeah, so I think that's right. I mean, so Chinese corporate investors, there are fewer of them, although they are getting very active, not just in China now, even outside of China. Again, the biggest ones, like Alibaba and Tencent, that's actually a huge part of their overall value of them as a company. They're so active, and their holdings in other companies contribute to their bottom line and the value of their companies, even on the public markets. So are they similar? I think, again, going back to the very beginning, what we talked about, Chinese corporate investors do tend to be a little more insistent on working in their ecosystems. And I think multinational corporate investors are less demanding on that. So that's probably one of the key differences. Again, it also goes to where you see the market for your company and its products, right? Again, Chinese corporate investors are going to take your focus to China. Maybe multinational companies, China is an important market, but they may be looking at your technology and seeing how they can work with you in other markets outside of China. So that's probably philosophically the differences from just a cultural feel or a process feel. You know, I think probably Chinese corporate investors can move much faster than multinational companies investors. So the speed, I think, is more favorable for Chinese corporate investors.
Yeah, that's very interesting tendency, right?
Yeah.
And Hausen has questions about what other benefits could startups consider seeking beyond capital from CVCs?
Right. Yeah, so obviously cash is good. Cash is great, and right now, you know, if you can get investment, you may not want to be so particular about whether it's coming from institutional venture capital or corporate venture capital. From corporate venture capital, I think you want to see where can they plug you into their customer base, for example, right? So a lot of, or other ecosystem partners, but primarily when you're an early stage company, you're looking for customers. Maybe the corporate venture capital for fund within the corporation itself can become a customer, but is that also a company that has a network of other companies? So look at a company like IBM, for example, right? So IBM making a corporate investment, a venture capital investment in your company. IBM manages supply chains and logistics and procurement, and has partners for that around the world. So if you look at getting investment from a company like that, just as an example, that can start to become a sales channel for you too. So and a stamp of approval as well for when you're going out, and credibility for when you're approaching your customers. So if you're deciding between taking money from an institutional investor and a corporate venture capital fund, that can be another difference. That's the credibility that the corporate venture capital investor can give you to go and get other customers.
Okay, I think you answered this question very well. And there's a MBA student called David. He has a question like, I'm doing my MBA in China and while doing my thesis on CVCs. I'm wondering if staff should ever be wary of investments from CVCs, since CVC might not be interested in the startup, but just its technology. Do you think so?
That's also a very good question, because if you think about it, what I talked about earlier seemed to suggest that if you take money from institutional venture capitals, again, you're on this accelerated timeline of having to help your investors be able to get their money out, right? So on one hand, you can think, okay, great, it's very clear, everyone's objective is clear, they come in for a return, so I just need to grow the company, find an exit, and everyone's happy. That's simple. Of course, that's hard to do in reality. And maybe you might think, okay, corporate venture capital is not as tough about a timeline, let's say, but yes. But what the question alludes to is, you know, maybe they are just interested in kind of checking you guys out and looking under the hood of what you guys have and seeing, you know, if they can work with you, or ways that they can use your technology in their ecosystem, but then, you know, they may not use it, right? So that's the other thing.
Mm-hmm.
An institutional venture capital fund is going to be very, not just going to put in money, but also being incentivized to help you find customers, right? So as the question alludes to, if I'm a corporate venture capital fund and I invest in you and I find out maybe that your technology is not the right fit for me, or for whatever reason, you may be stuck with that investor, and that investor then has kind of tagged you as in their universe, and it may limit you then from going and finding other potential customers that may be their competitors, or other investment from other corporate venture capital funds. So I agree. You do have to be careful with someone that's not necessarily just interested in a financial return, and may lock you into their ecosystem.
Okay. David was very interested with this question. He also asked the two questions about the topic. Mainly it's about, is there a difference in valuation when it comes to IVC and CVCs? Does CVC strategies on average get a discount from the investments because they can bring the strategy value? And also, how do you see the future of the VC industry in China?
Yeah, again, that's a very good question, because if you look at, let's say, M&A, starting with M&A first before we talk about venture capital, obviously, if you're selling to a private equity fund, let's say, versus you're selling to a multinational company, it's different, right? There's the financial interest from the a PE fund, and from a corporate buyer, they're bringing a lot of synergies, they're bringing a lot of value to the table, and they should get some of the benefit of that, whether you're talking about evaluation in terms of an M&A, a trade sale. Certainly that's the case. If you're talking about venture capital, though, probably less so. You know, in the case of a venture capital investment, there's no guarantee that you're going to have that deep collaboration that obviously a buyout will have. So there are synergies. There are things that a corporate venture capital fund can bring to an investment beyond cash that has value and should in some ways be reflected in the valuation. But I wouldn't overemphasize that too much, because again, especially at the early stage, there's no guarantee that you're going to have a deep collaboration. And you should, again, be cautious as a startup. You probably don't necessarily want to lock yourself into that deep of a collaboration at such an early stage in your company's life cycle. So I think for M&A, yes. For VC investments, probably less of a discount and less of a discount on the valuation.
Okay. I think today people are very interested with this topic, and we have asked most of the questions. If the audience has more questions to shoot out, feel free to just send us an email. Here is my contact information. I'm the Xnode's Acceleration Manager. Thank you for joining us today in this In Your Shoes event. And thank you, Art. You gave us such a good, excellent knowledge on the topic of start funding with corporate investors, VC investors. Thank you.
Yeah, thank you, Ian. And I'll say, if anyone needs to wants to reach out to me for questions or just to share their experience as well, you can find me on LinkedIn very easily. Just search Art Dicker. There's not too many Art Dickers in the world, so I'm easy to find. And so happy to connect on LinkedIn as well.
Thank you, Art. Thank you, though.